delighted to be joined by Will, Douglas and Claudia. I will just invite them to introduce themselves briefly and also maybe their investment focus, just so you can understand the spread of perspectives that we'll be discussing today. Maybe Claudia?
Hello everyone, I'm a career growth investor at Balderton Capital. Balderton is one of the oldest and largest VC funds based here in Europe, investing in European entrepreneurs with global ambitions. We do everything from seed to pre-IPO, and we've also taken a few companies public over the years in the UK. I specifically focus on Series B to pre-IPO investments. Great to meet you.
Hello, I'm Douglas, Doug Hansen-Luke. I'm the founder and chairman of Future Planet Capital. It's an impact-led, profit-first VC, aiming to invest globally, nationally and regionally, but always benchmarked against the best companies and the best minds coming out from the world's top centers of innovation. So for us, what we're aiming to do is to invest as much as we can in the UK, but only where the UK is leading and is going to be globally competitive.
Very good. I'm Will Clark from Mercia Ventures. So for those who are perhaps a little less familiar with Mercia, we're a listed business. We've been listed on AIM for about 10 years. We've got about 2 billion sort of under management. And in addition to a private equity offering and a private debt offering, probably about half of what we've got on funds under management fall under the venture category. So we're very much a generalist investor. We're a domestic investor, and we've got probably 35 investors based across the UK, including London, but probably 3/4 of what we do is in the UK regions.
Great, thank you. So let's dive in. So just to set the scene, looking at some of the recent kind of research reports, maybe from McKinsey, KPMG, and HSBC Innovation Banking. I think McKinsey referred to a bit of a capital crunch in venture capital last year. KPMG were talking about some dips in terms of VC investment in Europe and in the UK from Q1 to Q2. But HSBC were also finding that, the UK attracted more than 8 billion in venture capital, which is more than both France and Germany combined, representing 30% of all European venture capital. So I think I'd like to just ask you, just initially as a bit of an opener, what's your own perspective on these sort of findings in your own experience, and how do you see the investment landscape for VC, both in Europe and the UK? Maybe Claudia.
Yeah, it's a really good point to bring up. In some of these data and research reports, they actually exclude one very important thing, which is secondary volume. So it varies based on report, but then that doesn't capture some of the really impressive later stage secondary shares that have been trading, Revolut, Monzo, Starling, Tide. And so I also caution, take a second look at the data itself and the footnotes, because we've actually seen quite an active investment landscape. I think we're at a unique moment in time where there's record levels of dry powder from some of the COVID era funds that were raised that need to be deployed, but the new fundraising has stalled a little bit. It's harder for managers to raise new funds. Why is that? It's because the COVID funds haven't returned the capital and the prior vintages to their investors, to their LPs. So then they haven't been as eager to re-up. Plus you have non-traditional investors who were happy to, invest in the tech COVID bubble, let's say, that might not be as eager. So how do we solve that? So the number one word is liquidity. We need to focus a little bit more on providing liquidity to, as a VC fund, to our own investors, our LPs, so that they can re-up, and making sure that we institutionalize that. So I don't want to front run any of the other topics. We're going to talk about pensions, IPOs, M&A, but these are things that are top of mind for us.
Yeah, it's a huge issue. The gumming up on a global basis of private markets, whether it's venture or it's private equity, until those funds actually start returning money, you're just not going to see it coming through in the system. What is a real positive? Claudia's talked about not only the dry powder that's there, but also specifically here in Britain, we are seeing the pensions, the trustees and their end members all being united and saying they want to put money into venture. We announced that we were launching a fund for that. with NatWest Cushion. We've got a couple of LGPS coming in, but it's incredibly slow. So when you're doing this on a day-by-day basis, you're thinking, my God, is it ever going to actually happen? But if we actually think of the speed with which these pensions are operating compared to what they normally operate at, this is light speed, really, frankly. And it will all happen within 3 years. The question is, will we as an industry show returns and actually start producing the returns and the exits that's required to encourage those people to come in faster? Because they are coming.
And Will?
Yeah, I mean, I think it's always dangerous looking at these reports, which are limited in terms of data points, Q1, Q2, etc. Probably the one I take most notice of is the KPMG one, which I think was saying probably Q2 was about 30% down in terms of the UK. Q1 is always a busy quarter for us. Don't care what you say, but it's the fiscal year end always sort of focuses the mind somewhat. So Q1 was busy, and we were probably about 20% down on that, but that's not that wasn't to be unexpected. What I would say is there seems to be a real sort of mood, in our business coming back, after the school holidays, etc. And I'm assured 4 deals are going to happen in September, so it's going to be a really interesting team meeting in October if they don't happen.
Absolutely. You can see just the pace of press reports, large mergers announced yesterday, and a big sale, I think, at the end of last week. Very interesting. So, okay. And also, I think this morning, Sir Nigel Wilson was talking about look to the horizon, and, really picking up on your point, Douglas, the need for rapid change is definitely sort of felt. And I think what the Chancellor was talking about this morning is just sort of reinforcing that in terms of the pace of change. So, in terms of macro uncertainty, global trade, regional tensions, etc., to what extent are you seeing this having an impact on VC investment opportunities in the UK and Europe, or maybe more broadly? And Will, I know you had something this week on that, so perhaps you could just comment on your thoughts there.
Yeah, it wasn't intentional. So no, we did a little piece just around sort of US expansion. So again, just for context, we've got I guess a sort of a wide number of sort of entrepreneurs, founders, and we see our job to really try and amplify, their story. So I think, they always find a way. So whereas I was just saying we need to have on the board agenda, what are we doing about this sort of uncertainty? What are we doing particularly around tariffs? These guys, girls, they've already got solutions. So, one, for instance, sort of selling hardware to the US, they've just adjusted the recommended retail price. And the support package that goes with it, has changed. So, that's the sort of innovation that's there. But
and reclassification, I think, of a piece of supply from China, or
yes,
getting alternative supply,
all of that, and then maybe see some assembly in the US. So, these are really, really sort of innovative people that we're fortunate to be, brushing shoulders with.
Yeah.
I think one thing that we have also seen in terms of that's the US piece is, which I think is worth raising, given the increased focus on capital efficiency, which is probably sort of started with the US sort of shift, rather than actually sort of putting a new team on the ground and spending a huge amount of money recruiting some high-value people, we've had a couple of founders who have actually chosen to rebase themselves in the US, and that seems to be working really, really well. So I guess we've got to just think about well-being and everything, but it's something that Balderton do as well. But getting that sort of founder sales mentality into a new geography seems to be coming through.
Maybe Claudia, do you have any insights?
Yeah, it's a really good point. For anyone who's trying to expand to the US, we actually recommend that at least one founder or senior member moves. And so in terms of tariffs, they mostly impact things with hardware, but much of our investment is more in software, asset-light type companies. So I'd say minimal disruption from the company side. If anything, the disruption causes opportunity for new software to come and solve these complex problems, because we're still living in a very global world. From the talent movement, I'd say it's become a smidge harder for people to get visas going to the US, and maybe I'd also say in some ways the desire to go, let's be honest, given the current political situation. But the good thing about the US is that they welcome entrepreneurs with open arms. They see that as their competitive advantage, creating a good ecosystem. But luckily, here in the UK, and for one of the bright spots of tech being AI, we have one of the best ecosystems for that. It's no coincidence that OpenAI opened up an office over 150 people in King's Cross, conveniently located close to Google DeepMind Research Lab, and the trains to go to Cambridge and Oxford. And so one country's trash is another person's treasure, let's say.
I think that's really important for us in Britain. The revenue side of trade barriers in our industry, particularly in venture, it's much less of a worry. The capital side, there's two opportunities, one which we're seeing already, which is we invest a lot in companies coming out of universities. The number of founders who are saying they're finding it a lot easier to recruit, so much easier now because people from America want to come to the UK. They're not yet put off by our taxes. They've got to pay tax anyway. So that's not so much of a concern for them. You've got people like Larry Ellison and the amount that he's putting into Oxford and around there. So we can see that. But that then relates to something which we as an industry have to do more of in Britain. We've invested in open evidence in America, Grade AI, $3.5 billion valuation for a pretty small database for physicians. We've got databases in Britain, massive databases, which we've got Wellcome and Johnson & Johnson invested in for a whole 40 million. It's like Rome's World and Dr. You're seeing the difference there in that scale. And of course Americans and of course international investors from the rest of the world are going to come to Britain for our AI talent, but it's down to us as an industry who are putting that capital in to get more value for it. So I think the opportunity is there, but the challenge to all of us is to actually really help our companies take advantage of the fact we don't have trade, we've got far fewer trade winds in revenue generation than others. We can get into great intellectual capital and human capital here. Let's now actually start pricing it.
Yeah.
And it's interesting looking at how AI is obviously a common thread running through so much. The tech wave that's been talked about already this morning. If we look at things like defense, for instance, and the kind of flow of money coming in, I think in Europe, the larger fundraisings this year were Helsing, Quantum Systems and Techava, right? And I think Quantum Systems was a Balderton investment.
Yeah.
So I wonder, just in terms of your observations, Claudia, perhaps on that, and we've got London the Defence Arms Show coming up this week. How do you see the scope and the opportunity in that space, and in particular trying to kind of generate more opportunities of value?
I think defense tech in Europe and UK, incredibly exciting because of the ecosystem differences here versus US. Europe has 10 of the top 20 defense primes globally. A very underappreciated fact. It's just that it's so deconsolidated that it's country by country, their own government buying for them, and then very few breaking out into being those next gen primes. So that's the bet we made with Quantum Systems, because they're able to actually not just sell to their German-based, not just sell to Germany, they're selling to UK, US, Australia, all allied nations. And the key advantage that they have is proximity to the current conflict zone. They are defense only, but just having battlefield proximity, the ability to iterate, the more real-time nature of it. Europe has an advantage in defense tech that the US can't directly compete with, and actually they're pulling away in their investment. And so this is an area that we're incredibly bullish on. And I think in terms of the whole ecosystem, it's the VCs are bullish. The LPs who trust us with their dollars are also recognizing the need to rearm Europe, to have the self-reliance that wasn't necessarily there 5 years ago, or let's say pre-Trump. And that's a really powerful thing because everyone's aligned on the same page, to the point where you even have the US mega funds coming out with big splashy headlines. Hey, we want to invest in defense tech in Europe. We believe our dollars will be well allocated there. And a broader point, I think, that stretches beyond defense, even into general tech. So if you look at the concentration of the S&P, any US-based investor is thinking, how can I diversify my portfolio against this highly concentrated index? that is also largely driven by passive investors. And so there's a lot of excitement in private markets, including venture capital, private equity, private credit. And it feels like the demand for investment here is much greater than the supply, so that we're in a unique moment to capitalize on that.
And Douglas, I think you've got space flux and cryogenics, so there's sort of dual use kind of areas. Do you want to maybe just elaborate on that and the opportunity that brings?
Absolutely. We're an impact-led investor. Right from the beginning when we were founded, security was one of our impact verticals. At the beginning, people were talking much more about food security, cyber security. Now it's very clearly defense. There is no prosperity without peace. If you want to solve poverty, you've got to provide a peaceful environment. I mean, it's difficult to make money in Ukraine right now if you're being attacked by Russians. So having the defense area is something which, when we first started that, and we'd have pictures of soldiers on our impact pitch decks, we got a few raised eyebrows. Now, yesterday, I was at the Defence Establishment Conference, which is packed, and you can see how much is being invested and how much people care about, and going straight from that to an impact seminar where all they wanted to do was talk about defence. So certainly, if anyone in this room right now who is thinking about should they invest in defence or not, will they be hauled over the coals by pension funds if they are, the answer is absolutely not. You can do it, and you'll be able to make money. And not only that, as you just said, there's a large part of what we're investing in, which is dual use. So for the last few, at the beginning it was right, we're investing into swords that we're going to turn into plowshares, and now you're doing both.
And you've got the industrial strategy, right? And the arc for the next 10 years.
Absolutely. That framework house, we're managing money for the Ministry of Defence, the Royal Navy, and also for the space agencies. And, the forward thinking there is really very impressive. What we do have to use the expression capital efficiency. I always mean that just means we don't have very much money. So, instead of throwing huge amounts of money, we've at problems, we've got to think of very cheap ways to do it. So picking where we invest in space, for the amount of money that Britain is putting into space, we'll get 2 kettles. So you've got to make sure that instead of investing in kettles for space, we're investing in the right type of antenna, or we're investing in, space flux, collecting space debris. So you've just got to be very efficient, very, very focused in what you invest in, because you don't have as much capital as other people.
Yeah. Thank you, Douglas.
And I'd sort of expand on that. So some of the funds that we're managing, our biggest LP relationship is actually British Business Bank. So we've got sort of the ISVCT funds, but actually defence is now sort of on limits with those new funds. So we too have been trying to do a sort of a mapping, looking at it slightly differently in terms of, where have we got existing sort of businesses that may be doing some sensing technology, some lightweighting? How do we potentially open doors into defence, secure comms, etc. And then the other thing we're doing is working with an advisor. I still don't know his surname. Tells you where his previous employment was, but trying to look at, are there potential spin-outs from GCHQ where there is that dual application, and can we actually back some startups that way?
Okay. So just coming into the sort of the supply side, if you like, in terms of pension capital, and we were hearing already from the Chancellor all those changes, the pension investment review, Mansion House Accord, building on the compact, etc., and the consolidation of the LGPS. So to create these kind of 8 pools, these 8 mega funds. I guess, Douglas, particularly for you, given your involvement in the British Co-Investment Fund, but do you see this alternative supply really kind of moving the needle? And going back to the point earlier about pace, now how is this going to really make a difference? And what's needed to really drive that forward?
Well, it's certainly crucial, but it's not crucial in the sense of it's a great opportunity and we can take advantage of it because we're a scientific superpower and all those other things. It's crucial because we put, as we heard today, less than 0.4% into venture, into investing into the future, and the average around the world is much closer to 4 to 5%. So we're massively behind. I get a little bit nervous when I hear us in the UK being very complacent about being a scientific superpower, the 4 best universities and all these other statements. Absolutely right, but we're behind. We have a great opportunity to catch up. And that pace element which I'm glad Michael is referring to, and I think people refer to more and more, is if we don't move at pace now, then this catch-up opportunity is going to be taken by someone else. And AI and all the other technologies that we're seeing mean that whoever is moving now will be able to catch up that much faster. And it really should be us, and we need to do it, and we need our private sector to actually be doing it. At the moment, it's British Business Bank, it's EIS, it's VCT, it's the taxpayer. You know, the government, whether Conservative or Labour, voters all get it.
Yeah.
And our pension funds say they get it. We need to help the pension funds, and we've been doing a lot of this, actually connect their multitude of stakeholders. All of them are saying we want to do it, but they have this massive collective action problem, which I think, again, within our industry, we can help them identify what can we do now faster, because if we don't do it now, we're missing out.
Yeah. Thanks, Douglas. And Claudia, when we were talking earlier, you mentioned nice personal little data points. Do you mind elaborating on that in terms of what it means for the person in the street?
Yeah, absolutely. So my mother in New Jersey is a public high school teacher. I said, "Oh, Mom, can I look at your pension docs?" 13% invested in alternative assets. So that's, PE and VC. So it was this beautiful moment where I said, "Mom, you know what I do every day? I'm helping you pay for retirement without actually pulling cash out of my pocket." And so it's so important that we have that kind of long-term capital put into the tech industry. And alternatives means, a whole broad skew of things in more of an indexed approach, let's say, so that it's, safe and well diversified, so that not only we can fund the retirement deficit, we've all seen the population pyramids and how scary those look, but also to spur the investment so that it then creates more opportunities. To be a little bit more specific on that, we can invest in tech at the early stages, but Rachel Reeves actually mentioned we're lacking the presence of large mega funds in the same way that the U.S. has. So we get to a certain scale of company, in the 100 plus revenue, 200 plus revenue space, and then U.S. investors come in, maybe take it public in the U.S., and they reap the benefits of taking European companies public. And so we're missing out on that last step where you get the liquidity, where the employees who were responsible for these large innovations then get their payout and want to start another company. So that's on the talent side. And then on the public trading side, you need that capital in the market to drive liquidity, to drive better research, equity research coverage, to then promote more capital, liquidity, and trading. And so it's all related and very important that, as you said, the urgency is there because you have the opportunity to make up for lost time in a way.
And I think it's interesting. I talked to some of our pension leaders within Aon, right? So we're pension consultancy as well as insurance broking. And, our DC leader in the UK is like, but, I've got capital to allocate, but I'm not quite sure where to go in the private capital landscape. And that's why I think Nova in particular, so that's the BVCA's in consultation with the pensions industry, providing that almost filter to give some confidence to those allocators into where to go, because it's not an area they're particularly used to. So just a couple of minutes left to go. I just want to touch on the IPO kind of landscape. And obviously the reforms have been talking about in terms of supply side. There's obviously been Pisces as well, which the London Stock Exchange has been, was approved by the FCA recently, to really try and encourage companies to grow, scale, and ultimately stay here. Maybe Will, question for you. It's only dealing with secondary shares, right? So you're not raising primary capital, but it's essentially recycling and enabling companies to stay private for longer. What are your thoughts on that?
Yeah, I mean, I guess it's, one size does not fit all. So I think, the fact that we've got so much innovation coming, I think, the sort of the blueprint, in terms of what we've got and the sort of the infrastructure that we are talking about is probably the best that I can remember. So I think that's point one. I think, we've probably all had sort of, examples where we've got to situations where we're looking for a liquidity event because founders, they've invested 14, 15 years of their life and they've still not had that liquidity event and they need it. And therefore, there's been a pattern of effectively trade sales which are backed by US private equity doing a buy and build, and it's a bolt-on. It's really pleasing that the last couple of exits that we've had have actually been UK private equity houses wanting to use our business and our founder as the platform for a similar strategy. So I think, yes, clap the players, that's absolutely there, but we need these other mechanisms to try and ensure that we can give not only funds, but give those founders, a liquidity event to make sure that they're not going for such long periods without a return.
You've got to keep the conveyor belt of capital moving. And whether it's here or it's in the rest of the world, it has stuck. Fortunately, it's beginning to move again, but having as many different points or stops on that conveyor belt as possible is really important. So we just talked about that, whether it's IPOs or secondaries, whether it's trade sales or PE, just making sure that we're thinking about all of those prior to 2021. I think in venture, you could actually be pretty lazy. You say, put all of your effort into getting into the right companies, everything else. If you're in the right companies, everything else will work. And frankly, we've learned over the last 5 years, you've got to put a lot of work into those exits and making sure you've got all of the different options and routes available.
And you've got to start really early. You've got to start at the point of, point of investment. The item inflection was saying earlier, the importance of that value creation planning and taking that best practice and applying it to our asset class. Is something we're really keen and are doing.
Getting that playbook right.
And Claudia, I know on Revolut, for example, that's just something which has got its own momentum. It's got its own, so it's kind of outside that kind of framework. But you can see that it works. That the Pisces platform works in that sense.
Well, so the thing that Douglas mentioned of the lazy VC, Revolut is the exception of can be lazy.
Exactly.
Because it's really a generational company. But I really want to echo your point, because the playbook is so important. Actually, 95% of VC-backed exits are M&A. And so when we have these conversations with founders, it's not, hey, I want to do something else. I want to start my next thing, so now I'm going to go sell. It's like, no, once you get to a certain scale, which is much sooner than you think it could be in year 2, 3, 4 of the company, you need to be speaking with your most likely acquirers, which, by the way, are also your industry peers and who you want to displace. So it's a little bit of a funny dynamic, but they're very curious to learn what new technologies are emerging, how are they going to be displaced, and do they want to buy that business in 3, 5, 10 years. So that's something we highly encourage, is regular 6 to 12 month catch-ups with, your top 5, 10 most likely acquirers, and of course continuing that capital cycle. But the other thing I'll mention is that this private for longer theme is very important. It's important to not over-index to U.S. IPO markets. So to ground us all, the average age of a company to go public in the U.S. is 10 to 15 years. It fluctuates. And so I think we all hear about, there's this unicorn that was started 18 months ago. When are they going public? It's like, this is a very long journey. A small percentage of VC-backed companies will ever make that journey. And you have to hit certain metrics, a minimum revenue number, 150, 200 million pounds, to have enough scale that you can go public. If you do get to that scale, it's usually global, and so you actually have the option of listing in the US or the UK, or even staying private, because being public is not fun. It's a really heavy burden. You take on a lot of operational expenses that you don't necessarily need, and UK private companies actually have much better disclosures, the private ones, than anywhere else in the world. The Companies House website is phenomenal. So they're actually very well run from the beginning, because they have to be once they get out of the small business exception. And I don't think the private for longer situation is necessarily a bad thing. We just have to manage it by creating more liquidity in the secondary market.
Exactly. Fantastic. Look, thank you so much. Sage words. Thank you very much, Claudia. Thank you to Douglas and to Will. We're around later on to answer any questions you may have. Thank you very much.
Thank you.